Where do your insurance premiums go? A well-diversified portfolio. When you pay an insurance premium, you might think very often that that money is just going straight to insurance costs, straight to commissions, and payment for the employees and so on, and then just sitting there waiting for a disaster to happen, and then it's deployed, hopefully, into whatever risk you wanted to protect, whether that be homeowners, car insurance, flood, fire, life, disability, okay, medical. But there's a whole lot more to it than that, and thank God there's a whole lot more to it than that. So the way the portfolio works at an insurance company is very similar to a mutual fund. When you put your money in an insurance company, you're pooling risk with from risk on yourself with the risk of other people, something bad happening to other people, and all that money's coming together in the same way that money comes together in a mutual fund. And then if you buy a mutual fund or an index fund, or you just have an investment portfolio with a bunch of individual securities, you know, you're investing in other companies. So that means that at the insurance company, your money's not just sitting there. The insurance company is taking your money and they're investing it in their own portfolio of whatever makes sense for their the insurance that they're providing. Again, whether it be life or disability, property casualty, medical, whatever. Um, the 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 structure of their portfolio will depend a little bit on the type of insurance they're covering. Okay, so when you buy a mutual fund, you might have different investments in there like Disney, Apple, Nvidia, Ford, okay, Microsoft, Google. The insurance company's doing the same thing. It just might look, the allocation might look a whole lot different. Why? Well, the reason why is because they're taking on the risk that you don't want to take on. They need to take your $100 a month, and the moment that something happens, turn it into 1 million or 100,000 or 1 million, or maybe even 2 million or 3 million. You can't do that with a regular mutual fund or index fund. If I go invest $100 a month into a pool of investments, an index fund or mutual fund, it's going to take me several decades to get to $1 million or even $100,000. Um, in other words, I can't put my $100 a month into that fund and then file a claim or close my account and then get my money plus all the other investors' money. That's what insurance does. The key with insurance, though, is I can only get the other investors' money if I filed a claim and I'm eligible for the claim, if something actually happens to me where I need that claim. So this is very important that insurance companies are doing this, and the reason why is because we want to make sure that they can pay those claims. So, and I didn't mention in a previous video the detail of how you figure out what an actual premium should be, and how that risk is spread. Um, Best way to explain it might be through, let's call it homeowners insurance. Let's say you've got 100 households or 100 houses in a community, and for easy math, let's say they're all worth $500,000. So, and let's also say, for easy math, one out of those 100 houses each year is going to burn in a fire. Okay, that's a very high likelihood, by the way. 1%, that's extremely high, but it makes the math easy. So that means that let's say they all went to the same insurance company. Okay, so that means that insurance company needs to have $500,000 a year. Actuarially, they need to have $500,000 a year ready to go. So, what are we going to do? We need to divide the $500,000 by the amount of households there, 100. So we can so 500,000 divided by 100, that's 5,000. So we could have each household pay 5,000 a year. Now the insurance company has 500,000 a year. Now, of course, and again, the math here makes the realism of it a little weird. $5,000 a year for homeowners insurance on a $500,000 house. That's kind of a lot, but we're only spreading the risk between 100 houses. Normally, you'd spread the risk between way more houses than that, but it's making the math easy. So that means that, okay, now the insurance company needs to charge a lot more than that, right? Because they need to pay the employees and the overhead and for all the software that allows the advisor, the agent, to write the application and to generate the PDF of the policy and all the calculators to figure out the cost of the insurance, the cost of the policy, all the other administrative expenses, marketing, branding. So this is why your insurance premiums are high. It's not just because they want to price gouge you and keep your money. It's because they need to charge enough premium to cover the risk. And if there aren't that many people spreading the risk, but there's still a lot of overhead, they have to charge enough premium to stay afloat and pay the claims. And by the way, they're not like a bank where they can take your premium and loan it back out and not have all that money on reserve. That could be a whole nother episode or talk. But basically, banks don't need to have all the money that they say they have in your account actually in the bank. They can go loan it out to people. But the insurance companies need to have every single dollar on the books because they need to be ready to pay those claims. It's very different from someone going to the bank to just withdraw money out. That's different. Okay, so anyway, yeah, that'd be a good topic. So so those 100 households, they're going to pay $5,000 a year at least. They're going to pay definitely more than that $5,000 a year to cover all the expenses plus the insurance cost. So what is that insurance company going to do? They're going to, of course, pay the expenses, and then the actual insurance money, that $5,000 a year, is going to go into something called a general account. A general account. Every insurance company has this, a general account. This is the main account, or the general account. It's the main account that the insurance company uses to warehouse and invest their cash that they have to pay claims. So what does that immediately tell you? That immediately tells you that they don't want to take on a lot of risk themselves with that money. So they're not going to invest it the way a 25-year-old would invest in an IRA. They're going to generally be way more conservative than that, more like a retiree or a pre-retiree. They're going to have lots of corporate bonds, investment grade bonds, government-backed securities, government bonds. There's going to be a lot of different things in there. There could be real estate, precious metals, mortgage-backed securities. There's going to be some good, reliable equities, maybe dividend-paying stocks. It's going to look a lot like a mutual fund. So you're basically I hesitate to use the word invest because it's insurance, but the insurance company invests your money. You're not investing your money. You're paying for insurance. But the insurance company is taking a portion of your premium, and they're doing their own investment into this well-diversified portfolio of stocks, bonds, mutual funds, precious metal, real estate. Hey, nowadays, maybe even a little bit of cryptocurrency, crypto. So it's going to have all sorts of different investments, maybe even domestic and foreign currencies. So there could be a lot of cash in there, maybe some private equity, private debt, private credit, right? A lot of institutions will do that. And so that's hopefully going to grow that money so that whatever's not being used to pay claims, whatever's not being used to pay claims, can earn a little bit more. And then they would use that to do many different things. The good things would be, pay dividends to policyholders if it's a mutual company. Maybe lower premiums later on. That's rare, but it does happen. You do see that happen later on. Again, most of the time, if you're cynical, you're going to think that they're going to use that money to just pay commissions or give bonuses to executives at the insurance company. But that's not a wise thing for an insurance company to do. Why? In my scenario with the 100 households, that premium only accounts for one house burning down. What if there's a statistical anomaly or a statistical phenomenon? What if there's and two houses burn down, or three or four or five houses burn down? What if someone's belligerent and commits arson? What if there's a natural disaster, a terrorist attack, an invasion? What if there's a domestic violence, and there's a riot? Okay, like in Minnesota in 2020, the George Floyd thing. Okay, so what if things like that happen? Now the insurance company has to pay for two houses, $1 million. That's double the premium essentially. You're only paying $5,000. Well, they needed to charge $10,000 to cover that. So it doesn't make financial sense for an insurance company to make a profit just to pay, or in the general account, to make a profit in the general account just to pay bonuses. If anything, those bonuses or things like that, they're already factored into your premium because there are already regulations that the government sets that block how much insurance companies can pay the employees and agents. So there's no cynicism there. They're using your premium to grow for statistical anomalies. And remember, they're charging more than the raw cost of insurance to cover expenses and salaries and payments anyways, commissions anyways. So that portfolio is hopefully earning really well, and then that will account for some anomalies. Now, let's say the opposite happens. Let's say no houses burn down. That's fantastic. Now we have a year's worth of surplus. Now the general account has an extra $500,000 just in case there were no houses burned down this year, but next year 2 houses burned down. Well, that just means we had 2 years now to build the portfolio. So that's 2 more years. That's 1 extra year of gain to cover that risk. So it's a nice strategy. It's a very nice strategy. Again, they're not just sitting on your premium, and they're certainly not just sitting on the premium betting on you not having anything happen. A lot of people think that as well, that they buy insurance thinking, okay, so I, for example, life insurance. I actually had someone say this. I bet, okay, I'm going to buy life insurance, and I bet that you. Or no, they were talking like the insurance company. They're saying, okay, so you're taking a bet that I'm not going to die in the next 20 years. Okay, if you're 30 or 35 and we're an insurance company, we're not in the business of betting on whether you're going to die. We already know statistically how many people are going to die. So we're just going to charge the premium anyway that we know we need to charge to cover the claims that we would normally need to claim, or we would normally need to cover for that age and gender and health when we're talking life insurance, that age and gender and health profile of an insured. We're not just saying, you know what, like we're sports betting or something, like it's a one time thing. You know what? 30 years old, 35 years old, male, non smoker. I bet you $50 you're not going to die. That's insane. If we were betting, then where there's no science behind that, and the insurance company would probably lose. Um, they would probably lose more often than they do. And insurance companies are you don't want to be in a society where insurance companies are always losing. You don't want to be in a society like that, because then you really have, if people are already upset about insurance premiums and companies now, imagine if the insurance company was losing. Now they would find ways to charge more premium, tighten up the claim eligibility. They would tighten up so many things, and that's just what a weird way to think, right? Um, okay, you're going to take a bet on me not dying in 20 years. Okay, so does that mean that you as the insured are taking a bet on you dying in 20 years? What a way to live. I'm 35 years old. You know what? I bet you I'm going to die in the next 20 years. Let's buy life insurance. That's insane. You know what? Let's buy this homeowner's insurance. I bet you my house is going to burn down in the next 20 years. I bet you it's going to happen. Let's buy this insurance. That's crazy. No, the insurance company, the insurance company is already actuarially charging the premium that they need to charge to cover all the expenses that they have and cover all the statistical likelihood of that risk profile actually being claimed on. So the premium's already set. There's no betting in there. It's statistics. Um, Now, back to when I said that the insurance premium could go down later on, if there's a profit. When you start to deal with insurance companies who are very, very large and have an ridiculous surplus, that all their claimants could, or I'm sorry, all their insureds and owners could file claim, and the insurance company could pay all those claims and start all the way over. Those companies are going to pay things like dividends or lower their premiums later on, because yeah, statistically they're still maybe in the same situation where they're like, okay, the risk here is it's the same, but we've got more money to pay it. So they might turn around and make a lower premium to try and get more clients, or they're going to pay a dividend to reward existing clients, or offer a dividend to um, people who are not a client yet, not a policy owner yet. I should say policy owner, not client. So, so that is what's happening with your money. Your money is, you're not investing your money, but your money is being invested, if that makes sense. And it's a wonderful strategy. It's the same thing that other businesses will do. Banks are turning around and loaning your money out so they can earn and pay interest. Other non-financial corporations like trucking companies and things like that, coffee shops, okay, restaurants, you want to have cash on your balance sheet so that you can cover expenses and anomalies and have some growth in the business, so that you can retain and reward employees, so you can retain and reward customers, so you can be there to cover expenses. And again, your money is going into what looks a whole lot like a mutual fund. If you actually look at the portfolio, it's going to look like a collection of dozens and maybe even hundreds, probably thousands actually, if it's with an institution like an insurance company or a bank. If it's with an insurance company, that portfolio looks a whole lot like a mutual fund, like a balanced fund, maybe a conservative income fund, things like that. And then that's the account that if it's a mutual company, it pays the dividends. And hopefully it goes without saying, but I'll say it anyway. The more people that are insured, the more the risk is spread, which means the more premium coming in, which means the more compounding for the portfolio, the general account of the company. So that means that your premium does not need to be as high. One, it doesn't need to be as high because the risk is being spread across more insureds, more policy owners. And the more coverage you want, the less premium proportionately that you would have to pay. Because you're getting more coverage, so you're going to have a higher premium, but that means there's more money that the insurance company gets to invest from you and from the other insureds. So the compounding is greater, which offsets your raw need for premium proportionate to that benefit amount, that payout amount. So in other words, if you're, again, easy math, if you've got a premium of $100 a month for a $100,000 homeowners policy, that's a very expensive policy, but just makes the math easy. $100 a month, $100,000 homeowners policy or life insurance policy. That's what is that? That monthly premium is 1%. I'm sorry, 0.1%. 0.1% of the benefit payout. Well, if you want a $200,000 policy, your premium is not necessarily going to be $200 a month. Because the more money that goes in to the general account, the more there is to compound, and the more capital the insurance company has, but the risk to you is the same. The likelihood of your house burning down doesn't double just because you doubled the size of your policy. The likelihood of you dying doesn't double just because you want double the death benefit. So that means that if you now your premium still needs to go up, because the risk to the insurance company is still doubled, because if you die, now they need to pay out double, or if your house burns down, now they need to pay out double. Homeowners is a little bit different, but life insurance, if you die, they need to pay out double, but they don't need to charge as much premium because there's more investment growth on that money that's taking care of the doubling for you. So that means that the more coverage you want, the more efficient, the more cost effective your policies become. So as a financial strategy, when it comes to insurance, my suggestion is always transfer as much risk as you can financially afford. Obviously, you're paying a premium, and your budget, you got to account for your budget. So if you can't do $200 a month, don't do $200 a month. But if you're doing $100 a month, but you'd really like to do $150, you're probably going to get way more death benefit than that. If you look at the way the accounts work. Property casualty, I imagine it's the same. I don't know exactly, but it's more than likely it's the same. So that is where your premium goes when you put your money with an insurance company. A well-diversified portfolio that looks a whole lot like index funds, mutual funds, a well-managed, carefully managed investment account that usually, almost if it's with a big company, has a long track record of managing investments and managing insurance premiums. And last note I would leave here is that when people talk about cash value life insurance, the only insurance that you could consider an asset, when you're putting money into that account, an account like that, specifically fixed life insurance, so indexed whole life or fixed whole life, not indexed universal life, not talking about that. If you're doing whole life or indexed whole life, those premiums, if you're skeptical about that money and where that money is going, that is basically the same thing as assuming that you could invest your money better than a multi-century old insurance company who's been around longer than you've been alive and longer than your grandparents have been alive. You're basically saying, I think I can do better than this institution who's been around for centuries. Most businesses flounder in a year. Most of them. There are very, very few corporations and institutions that are around for decades, centuries. They're all banks and insurance companies. So they probably know what they're doing with your premium.